Welcome to Chapter 2. Now we're going to start analyzing and recording transactions the way we actually do it in modern accounting. So here are the conceptual, analytical, and procedural type of objectives we'll be looking at. The steps in processing transactions and the role of source documents. What is an account and its use in recording those financial events, transactions. What's a ledger and a chart of accounts? Define debits and credits, and what is double entry accounting? On the analytical side, we will look at a little bit of the analysis, analyze the impact of transactions on accounts and financial statements. We're not going to make you responsible for A2. But in the procedural, we will do all three steps, and that is record transactions in a journal and post these journal entries to a ledger, so we need to know what these things are, prepare and explain the use of a trial balance, and then prepare financial statements from business transactions. So let's get started. We're going to now begin looking at the steps in processing transactions and the role of source documents. Now, you've already done this in Chapter 1. Take a look. Business transactions and events are the starting points of financial statements. So something has to happen in business, a financial event. The process from transaction to financial statements, how do we get that little piece of data into a financial statement? We're going to identify each transaction and event from its source document, whether it be a check, a sales invoice, a bill received in the mail. We're going to analyze each transaction and event using the accounting equation, which we've already seen back in Chapter 1. We then will record the relevant transaction and event in a journal. So we need to understand what a journal is and what a journal entry is. We will post journal entry information to ledger accounts. So we've got to define a lot of stuff here. And then we prepare and analyze the trial balance and financial statements. So let's get started. First of all, our source documents. What do businesses, how do they know they had an external business event? Financial event, sorry. Here are some examples. They get a bill from their supplier. There's a sales receipt from selling to a customer. There's checks they wrote. There are purchase orders that have been completed. Payroll records have been processed, or maybe they received a bank statement. Now in our course, we won't use these things, but that's how a company identifies transactions. We're given the transaction in a statement. A regular statement, when I say that, I don't mean like a bank statement. I mean collected cash on credit. That's what I'm talking about, a statement. What is an account and how is it used in recording transactions? Well, an account is just a device we use to track increases and decreases in each asset, each liability, and each part of equity, including revenues and expenses. So it would be investments by the owners, withdrawals by the owners, each revenue, and each expense. So before in Chapter 1, you saw our accounting equation with columns. Well, now each column will have its own account. The general ledger is the title of the book that houses all of these accounts. So you can think of an account as a page in a book where we're keeping track of maybe cash. When you close the book up, the book has a title, and that is called the general ledger. So each asset, if you want to look at it, think of it as being in a file drawer, each asset will have its own account, and all the assets together are the asset accounts. Each liability and each part of equity. So it's just an illustration to try to help you wrap your head around what an account is. Each asset will have its own account. So cash has its own account, just like it had its own column. Accounts receivables will have its own account. Remember, that's where we keep track of amounts customers owe us from sales. Here's another type of asset. It's called a notes receivable. That's when the company, our company, loans out money to others as almost like a bank loan. So we're going to demand not only repayment of our money, but also interest. We'll tackle those later in the semester. Something called prepaid accounts that when we get to them, we'll take a look at them. Supplies, equipment, buildings, land. So we don't have one account called assets. The asset accounts each have, or the assets I should say, each have their own account that we keep track of that specific asset in. Same with liabilities. Each liability will have its own account. Accounts payable, notes payable, accrued liabilities, which we'll talk about later, is another type of liability, and unearned revenue, which is another type of liability. Don't worry too much about what it is. Focus on accounts payable and notes payable, and as we go through the chapter, we'll talk more about it. The point of this illustration is to show you each one of these has its own account. The same with equity. Owner capital. Remember, owner's capital always increases the accounting equation. Owner withdrawals will have its own account that we're going to accumulate all the withdrawals in it. And it always has a negative impact on the accounting equation. Any type of revenue, each one will have its own account. And revenues have a positive impact on the accounting equation. And then finally, there's expenses. Each expense will have its own T account. And remember, expenses have a negative impact on the accounting equation. Okay, so we're just showing you this information coming out of the file folder. You could think of this equity accounts as each having their own subfolders. So what is a ledger and a chart of accounts? This is really the ledger. You could think of, I call it the mothership. It's the center of our accounting system. It always is updated and it keeps track of everything. Specifically, it's the name we give to the collection of all of our accounts and their balances in an accounting system. A company's size and diversity of operations, so if they have a couple different lines of businesses, affect the number of accounts needed. So there's not a standard list out there that everybody uses. Each company will decide what type of asset accounts it needs, liabilities, and equity accounts. Now what you see below in this is what we call a chart of accounts. A chart of accounts is a list of all the accounts a particular company has. So we always need to have one of these at our disposal. We can't just start with a blank piece of paper and say, do the accounting. So with experience, you'll know the typical type of accounts a company may have based on the industry they're in. Some computer softwares will say, oh, are you in the food service industry? Here's the chart of accounts most food service companies use. So you could modify that, though, to what you want. You're not locked in to do it one way. In your book, your author likes to use account numbers as well as names of the various assets, liabilities, and equity. And this is a standard numbering system, usually across computer systems. Assets are usually signed 100 numbers. Liabilities usually start with a 2, so 200 numbers. Equity, capital, and withdrawals usually are 300. So anything to do directly with the owner putting money in or taking money out is a 300. Revenues are 400, and expenses are 500 or 600, and this author chooses to use 600. Again, some software systems don't require you to use account numbers, but since your author does, we're going to talk about them and use them. Now, before we could even start recording a transaction, we have to define this thing, debits and credits. You might have heard of them. Now, if you have a debit card, so you say debit means decrease. No, it doesn't. The banking system came out with debit cards in 1992 or 1993. Debits and credits were created in the 1400s by an Italian monk. So please, any analogy you might make with your real life between debits and credits, please just forget about it and ignore it and just take it for what the rules are. Now, what you see in front of you is one type of an account. It's called the T account. And I love T accounts, but your author likes the other type of account. I will encourage you to use the other type of account. But to understand debits and credits, it's really nice to use a T account. Remember what an account is. It's a place we keep track of increases and decreases in various assets, liabilities, and parts of equity. The left side of a T account is called the debit side. So the left side of an account is always the debit side. The right side is the credit side. That's the definition of a debit and a credit. Left side, debit, right side, credit. Now, to different types of items in accounting, they mean different things. For instance, an asset. The rules for an asset. A debit means increase for an asset, and a credit means decrease for an asset. So if an asset is increasing in amount, more cash is being put into the company. You purchased more equipment, so you want to increase the equipment. A customer owes more money on account, so you want to increase accounts receivable. You will increase those accounts on the debit side. When those asset accounts are decreasing, you're paying out money. A customer paid on their accounts receivable, so you want to decrease accounts receivable. You will decrease that account on the credit side. So to an asset, a debit is increase, a credit is decrease, and that's the rule for all assets. Liabilities are opposite. When a liability increases, it increases on the credit side. So when a company takes a loan and owes more notes payable, they will increase the notes payable on the credit side. When a liability is decreasing, you're paying on your accounts payable balance or your notes payable balance. So you're decreasing the amount the company owes. You will debit the liability. Equity. Equity's normal. So when I say, well, let's back up a second. When it comes to our equity accounts, investment by owner or capital, withdrawals, any revenue or any expense, your focus right now is to always increase those accounts. Always. Because we're accumulating in them. The only thing that will increase or decrease during Chapter 2 will be assets and liabilities. Everything else you're focusing on increasing. So normally we increase equity on the credit side and decrease it on the debit side. So I know this is small, it's also in your book. What does that mean? Well, what does it mean to the specific items? Well, since owner's equity is owner's capital, and this is where we keep track of all the investment money the owner puts into the company. Since the owner's capital is a positive impact on the equation, we increase on the credit side of owner capital. You won't be decreasing owner's capital till Chapter 4. Since owner withdrawals has a negative or opposite impact, we increase withdrawals. So whenever the owner takes more money out, we want to keep track of all the money they took out. we will debit the withdrawals account. Since revenues has a positive impact on the accounting equation, whenever we sell more or do a service for a customer and have revenue, we increase the revenue account on the credit side. And expenses, again, whenever we have an expense, we want to keep increasing that expense account so we can get a total amount of expense. It's all about accumulating. Since expenses have a negative impact on the equation, we debit the expenses when they increase. So the owner withdrawals and expenses increase on the debit side because their balances decrease the accounting equation, but capital and revenues, we increase those on the credit side because they both have a positive impact on the accounting equation. And that Dr. Pacioli, who wrote these rules back in the 1400s, knew what he was doing. They just always work. So if you debit and credit properly, assets will always equal liabilities plus equity. One other thing you need to remember is at all times, debits must equal credits. So, what is this thing, double entry accounting? And kind of take us too far forward, but let's say now you have this cash T account and you had various transactions affect your cash T account. Take a look. You have 30,000 cash you received, and you'll see how you put this amounts into these accounts and increase and decrease them in a few minutes. What this slide is meant to do is show you how to determine the balance in an account after you've collected all of the transactions that affected cash in the cash T account. So there were various increases. How do I know that? Because there's debits, and debits are on the left. So we received an investment by the owner. We received money from services we rendered. We collected on an accounts receivable. So we'll add up those three individual amounts. They equal $36,100. Now we'll go to the credit side of the account. And those represent decreases to cash. And I could tell by looking at the credit side, the right side, purchase of supplies, purchase of equipment, payment of rent. These are all payments we made, and those are the purposes that we made the payments. We'll add up the credit side of the T account, and they equal $31,300. What I always tell people is subtract the smaller side, the smaller total, from the larger total. That's the balance. What side of the account does it go on? The side that had the larger total. So since the debit side had the larger total, the $4,800 balance will go on the debit side. And if you're using T accounts, that's how you find the account balance. But how the heck do we get to this point, right? Let's start from the beginning. The very first step in our accounting cycle, and that's what we're starting to do. It's called an accounting cycle. An accounting cycle defines all the steps we need to take in a one-year period for our company. Sometimes people call it the accounting year. So we start with, we record these external financial events in a journal. And each financial event, we actually make what's called a journal entry. The journal entries all together, book closed, has the title journal. And then we do something called post these journal entries to the general ledger. Remember, we talked about the general ledger a few slides ago. Those are all the accounts in a book, and it says ledger or general ledger. So they give us a little picture here. This is nice. So we identify our source documents. We could take a look at how they affect the accounting equation. and use our chart of accounts. Remember, a chart of accounts is just all the accounts that are available. It lists all the assets we have, liabilities, and parts of equity. And then we create this thing called a journal entry, and we're going to show you that. And then we take the information from the journal entry and put it into this thing called the ledger, the general ledger. Now, here are the parts of a journal entry. Part 1. Each financial event will have a journal entry. The first part of a journal entry for a financial event is the transaction date. So what day did this occur on? The next item we use, or we have to determine, is at least one account that will have a debit and one account that will have a credit. You need at least one debit and at least one credit. You could have more than one debit and you could have more than one credit, but you have to have at least one of each. You'll put the name of the account affected, and if it's a debit to that account, in the debit column, the dollar amount in the same row. Notice the account that will be credited is indented a little bit. And if you were doing this on paper, that's what you would do. We always write the actual name of the account that we will have to credit with its dollar amount in the credit column, but we always indent the title of that account. The final step is putting a little explanation of what happened in the transaction. You don't have to worry about memorizing these. And for those of you in the online course, you will be selecting from a drop-down menu. It's just a description of what took place. So it could be in your own words if you're writing this. Receiving investment by owner, or it could say from owner. Now, a few minutes ago, we saw a T account. So that's one type of account that could be used to keep track of transactions created in journal entries. But usually in practice, software is doing a lot of this. And what is the software doing? Well, it's using more of what's called a balance account. And the major difference is you still have a date. You have to put a date there. And the journal entry, the journal entry we just did, the debit of $30,000, that $30,000 for cash in the cash T account, $30,000 will be in the debit column. Debits increase, so now our balance is $30,000. Now you don't see these transactions, but on December 2nd, there was a journal entry that decreased cash. Something had to be debited, but the credit was to the cash account. How do I know that? Because there's $2,500 in the credit column here. So we're collecting all of those journal entries that are done to record each transaction. The second step is taking each one of them and posting the dollar amount either in the debit or the credit side of the appropriate account. So all transactions related to cash, any journal entry that had cash in it, the debit or credit will be recorded or posted into the cash T account. And that goes for all accounts. Now when we credit the cash account in a balance account, we immediately determine the new balance. Credits decrease cash, so 30,000 minus 2,500, 27,500 is our new balance in cash. Notice there's no brackets when we decrease. Nope, we don't use any brackets or minus signs. If it's in the credit column, even though it looks positive, we know the impact on cash is decreasing because cash is an asset and assets decrease on the credit side. Same with December 3rd. There was a financial event that caused a journal entry. when the journal entry was posted or transferred to the cash account, $26,000 decrease or credit. So we subtract the $26,000 to get to our new account balance. And then on December 10th, there was a journal entry that caused the increase to the cash account because there's a debit. So we'll add that. So our new balance in cash is a positive $5,700. The PR stands for post reference. And what that wants to know is, where did this number come from? It happened on December 1st, and it's in our general journal. So that's the G stands for General Journal 1, the first page of our general journal. So it's just giving a reference as to where it came from. Notice also up in the balance account, right next to cash, it says account number 101. So that's where we would be utilizing those account numbers. Oh my goodness, is that small, right? Let me get my magnifying glasses out here. So identify, the key here is to identify your debit account in the ledger. And here it is. Here's that first journal entry. December 1st, the cash account, debit. Now, when we post that $30,000 to our T account, we're going to put in the post reference in the journal. Remember, up on the top here is our journal with our journal entry, and we're going to have a post reference there. We're going to put the account number of the account we posted to. Why do we do that? So we know we finished posting to that. We know we transferred that $30,000 debit to the cash T account. We'll do the same thing when we post the credit amount of $30,000 to capital. Now, if you're saying, well, that's a credit, why is that positive? Remember, when you credit capital because an owner put more money into the business, you're increasing on the credit side. So that's a positive amount. You'll then transfer up to the post reference in the general journal the account number of the capital account, 301. We do this so that we can trace or follow a transaction from the journal to the ledger accounts it affected and back. Now, we're just going to do a little analysis, and then we do the whole enchilada. We're going to look at the whole procedure. Analyze the impact of transactions on accounts and financial statements. So remember, in double entry accounting, it's useful in analyzing and processing transactions. We follow a 4-step process. We identify the transaction and the source document. We analyze how it affects the accounting equation. We then record a transaction and determine what needs to be debit and credit in a journal entry. And then we post the journal entry to accounts. Now, in this illustration, they're going to use T accounts. So you're going to see both of these being used in your chapters. So here is our very first transaction. We identify it. Fast Forward receives $30,000 cash from Chase Taylor as an owner, or Chase Taylor as an owner contribution. So your first question is, what happened? Well, the company got money from the owner. Okay. What's affected by this transaction? So you can think about or have in front of you your accounting equation. Well, we got more cash. So the asset cash increased. Why did we get more cash? Oh, the owner put money into the business. So the equity increased in the capital area. All right. Now go one step further. When the cash asset increases, do you debit or credit it? We debit it. All right. Then we're going to write the word cash down and in the debit column put $30,000. Before we do the next step, you want to finish your journal entry. We also want to increase the capital for C. Taylor. And we always increase capital. We increase for more investment by the owner on the credit side. Notice again, the name of the account is indented when it's credited. The next step is posting. So you could either post to a T account or you can post to that balance account that we just looked at. They use T accounts just to keep the picture simple. But really, you're doing the same thing in the balance account format. It's just that you're determining a new balance in the account after each transaction. In a T account, we wait till the end of the time period we're collecting information for, and we come up with one account balance. So cash will be debited, so debits on the left, and we put a little 1 there to identify it happened on, or there's no official date here, but you would use either the date or that 1. You have to reference it. And you'll do the same with capital. And then notice over on the post reference in the journal, it says you posted the cash to account 101 and the capital to account 301. So those are the 4 steps of the process for a transaction. Let's take a look at another one. In this one, we purchase supplies for cash. So just like chapter 1, you're going to ask yourself, what was affected? Well, I bought more supplies, that's an asset, and I paid for them with cash. So the asset supplies increases, we own more of those supplies assets, but the asset cash decreases because we paid for them with cash. When an asset increases, we debit it. So supplies in our journal entry will have a debit. When an asset decreases, we credit it. So cash asset decreases on the credit side. Now, if you're sitting there going, wait a second, everything happened on one side of the equation in part 2. Doesn't something have to happen on the other side? No. Nobody ever said that. We just said the accounting has to equal after you post that transaction. Minus 2,500 plus 2,500, 0 equals 0. You're correct. Then you post the supplies and cash amount from the journal entries to their respective accounts. On the left side of the supplies account, 2,500, that's the debit side. On the right side of the cash account, the credit side, 2,500, because you're decreasing cash. And don't forget to put the account number from the supplies and the cash in your journal. So if we were using an account form balance, I'm getting it confused. A balance form of account, we would determine a balance of cash right now. It's just an extra step. So don't let them freak you out, these accounts. Here's our next one. Purchased equipment for cash. Again, okay, purchased equipment. So we bought an asset. Equipment is increasing. We own more of it. Do we pay for it? Yeah, with cash. So that cash is decreasing. So that's the effect on the equation, similar to what we just did. So we're going to debit the equipment account because we increase the assets on the debit side in our journal entry. And then we credit the cash account because it is decreasing in our journal entry. We then post the $26,000 debit to the debit side of the equipment account, and we post the $26,000 credit for cash on the credit side of the cash account, decreasing. And we include the account numbers in our post reference in our journal entry. So on the left side at the bottom is our journal, on the right side are our accounts in our general ledger. So we're really going from one book to another book. In the next one, the company purchases 7,100 of supplies on credit. Sometimes they'll say on account from a supplier. What happened here? We bought supplies. Okay. So supplies are increasing. Do we pay for them? No, we bought them on credit. So that means we owe the money and we keep track of amounts we owe to suppliers in accounts payable. So the supply asset is increasing, and the accounts payable liability is increasing because we owe more money. Now to illustrate that in a journal entry, we would have date number 4, supplies on the debit side 7,100, and then we would write out accounts payable and 7,100 in the credit column because liabilities increase on the credit side. We would then post or transfer, it's another word for transfer, right? The $7,100 debit into the supply account on the debit side, increasing it, and we would transfer the $7,100 credit into accounts payable on that credit side. We're increasing the accounts payable now. And then we would make sure we jot down the account numbers in our journal of each one of those accounts. Provide services for cash. Here, fast forward, provides consulting services. So they did something for a customer and immediately got $4,200 cash from the customer. So, wow, cash is increasing. We got cash. Why did we get it? Oh, we performed a service for the customer, consulting services. So our cash asset increases. And our revenue, remember, anytime we do something for a customer, we want to accumulate in our consulting revenue account all the revenue we earned from doing services, whether we got paid for them or not. How does that translate into a journal entry? Well, the cash asset is increasing. Assets increase on the debit side. Consulting revenue is increasing also, and that increases on the credit side because we want to keep adding in and accumulating all of that consulting revenue. When we post this journal entry, we'll have $4,200 on the left side or debit side of the cash account, and then we will post $4,200 to the consulting revenue credit side or the right side. Now we're going to pay an expense. It looks like Fast Forward pays $1,000 cash for their December rent. Okay, so we're paying cash. So cash is decreasing. Why? What do we pay for? Oh, we paid for rent. Rent's an expense. So remember, rent expense has a negative impact because all expenses decrease the accounting equation. So that makes us make sure our equation is in balance. But be careful. What are we focused on when we're creating a journal entry? Making sure we accumulate all the rent expense in the rent expense account. So anytime we have more of an expense, like rent expense, we debit it. We increase the expense account because we want to get a total amount of expense. That's why rent expense, $1,000 on the debit side in the journal entry. Cash is decreasing. It's an asset. When an asset decreases, you credit that. So cash will have $1,000 on the credit side. We then post the rent expense, $1,000 to the rent expense in the general ledger, the T account there on the debit side, and we transfer or post the $1,000 credit to cash on the credit side, as you can see. And don't forget about moving the account numbers over into your post-reference area of the journal. Ooh, there's a lot of these. Here's another. Fast Forward pays a $700 cash for employee salaries. So here's another expense being paid. And you're going to see the more you practice these, they start repeating. Every transaction in business is not unique. Okay? You're going to start repeating them. So that's why it's important you do lots of practice and repetition. So cash is decreasing here. They paid cash. Why? For salary expense. So salary expense is recorded. It has a negative impact on the equation. However, again, we want to accumulate all the salary expense. So we want to add this or increase the salary expense account. So we could figure out at the end of the time period how much in total salary expense did we have that will decrease the equation. So salary expense will be a $700 debit. Cash is decreasing. It's an asset. Assets decrease on the credit side. We could then post the $700 debit into the account salaries expense on the debit side and post the $700 credit to cash to that account on the credit side. Debits on the left, credits on the right. I'll have you watch a video about it. Now they're going to provide consulting and rental services on credit or on account. Fast Forward provides consulting services of $1,600 and rents its test facilities for $300. The customer is billed $1,900 for these services. Remember, we don't wait till we get money to record this type of transaction. What matters is, did we complete the service? And the answer is yes. So we must record this transaction. From this transaction, we earned $1,600 more in consulting revenue, and we also earned rental revenue of $300. Since we did not receive it in cash today, we have to increase the asset accounts receivable to show that it is owed to the company. So that's how it looks in part 2 in our accounting equation. Part 3, we actually create the journal entry. Accounts receivable is increasing. A customer owes us more money. When an asset increases, you debit it. So we're going to debit, write accounts payable, and in the debit column, put the total amount owed, $1,900. Remember, with revenues, we're always wanting to increase them so we know the total amount of them. Revenues increase on the credit side. So consulting revenue will be written with the $1,600 in the credit column, and then rental revenue will be written with a $300 amount in the credit column. Now, if you're sitting there going, whoa, there's only one debit and 2 credits, that's okay. What was the rule? You have to have at least one of each. And when you're finished recording a journal entry, debits must equal credits. And we're okay. We had 2 credits that equal $1,900 and 1 debit that equals $1,900. Now we can post that journal entry to the affected accounts in the ledger. So accounts receivable account on the left side or debit side, $1,900. Consulting revenue account on the credit side, $1,600. And rental revenue on the credit side, $300 is transferred. Don't forget about the references. You can see the little 8 here that identifies it as the date they're putting a number 8. You could either use an actual date or this is transaction 8. And don't forget to transfer over your account numbers as you post back to the journal in the post reference column. Receipt of cash on account. So Fast Forward receives $1,900 cash from the client billed in transaction 8. So what's happening here? Well, cash is being received. Why? Someone's paying us the amount they owe us. Oh, okay. So cash increased and accounts receivable decreased. Don't do anything with the revenue accounts again. If you increase the revenue accounts for this transaction, it looks like we did more work. No, all they're doing is paying us on what they owe us. So increase the cash. We do that on the debit side because it's an asset. Decrease the asset accounts receivable on the credit side because that's the rule. When you post that, take a look and you'll see it all come into focus here. The cash is on the debit side, so you're going to put $1,900 on the debit side of the cash account in the ledger, and the accounts receivable is a credit. So you see transaction 8 said, hey, debit, we are owed $1,900. But transaction 9 says, oh no, we were paid. So if we netted those 2 sides together, it would be 0. The customer doesn't owe us any money. Partial payment on accounts payable. So Fast Forward pays Caltech Supply $900 cash towards the amount they owed them from transaction 4. Well, what's affected? Well, cash was paid, so we're going to decrease cash. Why? Oh, we paid for something we owed. We owed on accounts payable. So we're going to decrease the balance of accounts payable because we don't owe that anymore. Accounts payable liabilities decrease on the debit side. So whenever you have a liability decreasing, you debit that liability. So you can see their accounts payable, $900 on the debit side. Remember, the cash is an asset and it decreases on the credit side. So there's our accounts payable being posted to the debit side. So it looks like in transaction 4 on the credit side, we owed $7,100. We just paid $900 of it off. So it's decreasing it. And then cash, of course, decreases as well on the credit side. Here we have Chas Taylor withdraws. So this is the owner withdraws $200 cash from the company for personal use. What's happening here? Well, cash was taken out of the company, so cash is going to decrease. Why? Oh, the owner withdrew it. Oh, so that means we have an owner withdrawals here. Withdrawals always has a negative impact on the equation, so our equation balances out. But how do we record that? Remember, with revenues, expense, withdrawals, and investments, we're always focused on increasing these accounts. We want to know the total amount of each one of these things. So we want to increase the withdrawals account. That occurs on the debit side. That's the rule. So you could see in our journal entry here, C. Taylor withdrawals, debit, 200. Cash is decreasing. It's an asset, so we have to credit cash. That's the rule. When we post to the withdrawals account on the debit side, we have 200. And on the cash account, we post to the credit side, 200. Don't forget your references and post reference in the journal. Fast forward, receives, oh, this is good, receives $3,000 cash in advance of providing any services to a customer. Whoa. So they got cash. We got cash. Why? The customer paid us early before we did anything. So what do we do with that? Well, I know revenue. We can't call something revenue till we actually did something for the client, but we didn't do anything yet. So today when we get the money, we owe the customer that service. So we actually increase a liability called unearned consulting revenue. And that is a liability which shows we owe that money. So we're going to increase the cash asset, $3,000 in our journal entry, and then we're going to increase the liability, even though it says revenue in there, it's a liability, unearned consulting revenue, $3,000. Now, if you're sitting there going, what happens when we do this consulting service? Chapter 3, we'll show you what happens. For now, today, we owe that service. You could see the cash on the debit side being transferred over into the cash account, and then the $3,000 credit being transferred into the unearned consulting revenue. So we were looking at the accounts before and we saw unearned revenue, and I said, oh, I'll talk to you about that. There you go. Here's another different type of transaction. Fast forward, pays $2,400 cash for insurance premiums for a 24-month insurance policy. Coverage begins December 1st. Okay, and so that means we haven't received any coverage yet. So we are actually prepaying an expense. Isn't insurance an expense? But the rules of accounting say you can't call something an expense until you've actually received the service. And the majority of expenses, that's what happens. We have something repaired, then we pay the bill. Our employees work, then we pay the bill. We have utilities for the month, then we get the bill in the mail. But insurance is a unique kind of expense. You always pay for it before you get the actual insurance coverage. So the day we pay for insurance, we can't call it an expense. It is something owed to us. So we call it an asset, and we call it prepaid insurance. And I think we talked about this a little bit back in chapter 1. So what's happening here is we're paying out the cash asset, so we have to decrease cash, but we're increasing the prepaid insurance asset to show that insurance is owed to us, that insurance coverage. Now, when an asset increases, we debit it. So in our journal entry, prepaid insurance will have a $2,400 in the debit column. And then cash asset is decreasing, so we credit it. We know that. So we'll write cash and credit. The $2,400 debit will be transferred to the prepaid insurance account on the debit side in the ledger. And then the cash $2,400 credit will be transferred to that account on the credit side. Here we're purchasing supplies for cash. So Fast Forward pays $120 cash for more supplies. I think we've seen this already. So cash decreases, supplies increase. We bought more of an asset. When a supplies asset increases, we debit it. When the cash asset decreases, we credit it. It's just the rule. We'll transfer the debit amount into the supplies account for $120. And we'll transfer the credit to the cash account on the credit side. When do these end? Fast Forward pays $305 cash for December's utility expense. So here it is. It's December. We got utility expense. All right, let's pay it. Okay, so we're not prepaying it. We already got the service. So we're going to have utilities expense, and expenses always decrease our equation, and we're paying cash, so cash decreases. Remember, with regards to expenses, we're always focused on increasing the total amount in that account. And so whenever we have more of an expense in a transaction, we debit. And in this case, we'll debit utilities expense. And since we're paying cash, how many times have you seen this already, right? Cash decreases, so we credit it. That's the rule. We then post or transfer the journal entry to the respective accounts in the ledger. So $305 on the debit side of the utility expense account, $305 on the credit side of the cash T account. Fast Forward pays $700 cash and employee salary for work performed in the latter part of December. Again, salaries expense, we're focused on increasing it. We increase salaries expense on the debit side. We'll be decreasing cash because it was paid on the credit side. That's our journal entry. We'll then transfer or post the $700 into salaries expense. Take a look at that T account there. 2 debits. See how we're trying to determine all the salary expense? That's why we debit it and increase it, even though the overall impact on the equation is a negative one. We've got to know the total to subtract. And then cash, of course, we're going to come on over into our cash T account on the credit side, put $700. Debits on the left, credits on the right. Oh, thank goodness, right? So that was great review of all different kind of transactions that could occur. Now, I know this is really small, but I encourage you to actually download the PowerPoint and take a look at it in a slideshow so you could see it in, sorry, just got a text. One of the schools I teach at, there's a fire. No biggie. They got it under control. Anyway, it's not a big, I didn't mean it that way. But anyway, let's get back here. So each account we will now find a balance in, and that's what's happening on this very small presentation. But like I said, if you go and you download the PowerPoint, you could see it bigger. I'm sure it's in your book. So remember, when you're trying to find the balance of an account, if you're using a T account, add up the debit side, add up all the credits. subtract the smaller side from the larger side, that's your balance, and it goes on the larger side. So in this case, the debits were more than the credits by $4,275. So that's the balance of the cash account. Accounts receivable, debits and credits are the same, so the account balance is 0. Supplies, there's only debits, so add them up, and that's your account balance, $97.20. Now, if you were using that balance account format, you would have been finding a balance after each transaction. That's the only difference between the two. Prepaid insurance has one transaction, so that's its balance. Same with equipment. Okay, so those are all the assets. So you see across the top here is our equation. So we listed all of our T accounts that are assets. Now add up each balance in each account. $42.75 plus $97.20 plus $2,400 plus I think that's $26,000, $42,395. Now in our liability columns, there's two liabilities. Accounts payable starts with a credit balance of $7,100. On the credit side, debit side's $900. Subtract the smaller side of $900 from the larger side and put the balance on the larger side. So the company still owes $6,200. Unearned service revenue, there's only a credit, $3,000, so that's the balance of its account. Add those two together, the amount of liabilities, $9,200. Capital only has one transaction as well as withdrawals, so those are the balances of the accounts. Revenues had two, add them together, so the balance of the account looks to be $5,800. Rent revenue has one, so its balance is $300. Salaries expense had two, so the total amount of salary expense is $1,400, debit side. Rent expense has one transaction, so that's its balance, $1,000, and utilities has a balance of $305. Okay, now if we took, and just to show you this, because in the equation format, if we took the balance of capital, $30,000, subtract the balance of withdrawals, $200, not only two reasons. One, withdrawals always is subtracted. It always has a negative impact, but also it has a debit balance. You can't add a debit to a credit. It's an opposite, so you have to subtract. So $30,000 minus $200 plus the, say, $5,800 in revenue, plus the rental revenue of $300, those balances, minus each expense balance, you'll get the balance of equity. Now, in the real world, we don't do that. We don't do assets, liabilities, and equity. However, you can do that to show my equation is in balance. We do find a balance in each account. So that process we just went through is very important. What do we do in the real world? We prepare a trial balance. A trial balance has 3 steps. First, we list each account and the amount of the balance in the T account or in the account in the ledger. If an account has a 0 balance, list it with a 0 in the normal balance column. What is a normal balance? The side of account that increases. So the normal balance of an asset is a debit. The normal balance of a liability is a credit, etc. Once you list each account with its current balance, be careful you put it on the correct side, you then add up both columns. And both columns must equal. Debits must equal credits. So take a look. Here is fast forwards. Trial balance. Cash, we always start with assets, by the way. The cash T account had a debit balance, see the debit column, of $42.75. Accounts receivable has a 0 balance. Its normal balance is on the debit side, so that's where we put the 0. Supplies has a debit balance of $97.20. Prepaid insurance, $2,400, and equipment, $26,000. Then we list the liabilities. The liability accounts payable has a $6,200 credit balance, so the dollar amount goes in the credit column. Unearned consulting revenue liability is a $3,000 credit balance. Again, goes in the credit column. Capital is our next account that would be listed. 30,000 credit balance, so you list it appropriately. Then we do withdrawals. That's our next listing. Be careful, it is a $200 debit balance. Then we list the revenues. There's two, consulting and rent, and they both have credit balances. And then we list the expenses. So we always go assets, liabilities, capital, withdrawal, revenue, expenses. And be careful we put the total in the appropriate column. And you can run through this exercise. Add up all the dollar amounts in the debit column. They should total $45,300. Add up all the credits in the credit column, the dollar amounts in the credit column, and they will also equal $45,300. If these two don't equal, you got to find out why. You cannot go to the next step. Now, what if we do have an error? Well, this gives you some information. First, make sure your trial balance columns are correctly added, so recheck your math. Now, before you start going and doing all these other things, there's a couple tricks. I'm going to give you one of them. Sometimes we accidentally put a debit in a credit column or a credit in a debit column. Here's what you do. Take the difference. If your debits and credits don't equal, take the difference between them. So say you had your debits were $14,000 and your credits were $14,100. So the difference is 100. Divide that difference by 2, 50. See if there's any debits or credits that have a balance of $50 and make sure, if there is, that it's in the proper column. Okay, so that's a quick way to see if you just put something in a wrong column. If that's not the case, you want to make sure your account balances are correctly entered from the ledger. So you got to kind of work backwards now. Okay, did I add everything up right? Yes. Did I transfer everything from my balances in my T accounts or my balance accounts into the trial balance correctly? Yes. Okay. Did I compute the balance of each account correctly? Yes. Okay. Then did I post or transfer each journal entry correctly? So you got to work backwards. The final step of our process in Chapter 3 is using that trial balance to create our financial statements. So now we have to prepare our financial statements from our trial balance. So you should have your trial balance in front of you. You have a list of the assets, the liabilities, and the parts of equity with their balance. Remember the 4 financial statements. Income statement reports revenues less expenses. So only revenues and expenses are on our income statement, and we report it for a period of time. Statement of owner's equity reports how equity changes over a period of time. What kind of things change equity? Owner investments, owner withdrawals, net income or net loss. That's reported on the income statement. Balance sheet. This reports the assets, liabilities, and equity at a point in time. The 4th financial statement, which we don't focus on in this semester, is the statement of cash flow, and that just tells how we spend cash and bring cash in for a period of time. So here's our income statement for fast forward. We grab our trial balance, which is a summary of our book, the general ledger. Because when we're making financial statements, we don't need to see all those accounts with all those dollar amounts in there. We just want to know the last balance. So we could tell people, here's where it ended up. So remember, income statement is for a period of time. In this case, it's for the month ended December 31st, 2019. So revenues are listed first. You don't have to put that stuff that's in brackets there. You take it right off the trial balance. Consulting revenue, $5,800. Now, one thing I want to stress to you is you see 2 columns on an income statement, but nowhere do you see the words debit or credit. It looks like we're trying to do debits and credits, but we're not. We use 2 columns because we have more than one revenue and more than one expense. So we want to put the detailed revenue amounts in the inner column and just the total in the outer column. So consulting revenue and rental revenue are listed and then added up, and the total is put in the outer column. Then we list each expense. Remember, expenses we don't show in brackets or with minus signs. The average decision maker knows expenses are not a good thing. Like they're necessary evil. They decrease our income. We add up our total expenses then, subtract our expenses from our revenues, and if it's a positive result, which is the case here, we label it net income. That's the profit, and we double underline. The next financial statement is the statement of owner's equity. They made that pretty nice and small, right? But remember, a statement of owner's equity shows how owner's equity changes for a period of time. Remember, owner's equity represents the amount the business owes to the owner. So the business starts the beginning of December. So there is no owner's equity as of December 1st. The business just started. So we have C. Taylor, capital, December 1st is 0. If the business was in existence before that, there would be a balance there. We add anything that increases owner's equity over the period of time we're looking at. So the owner's investment of $30,000 and the net income. Revenues increase equity, expenses decrease equity. We already showed the detail of both on the income statement, so just show the overall impact. Net income increased. If there's any decreases, which the only thing that would decrease owner's equity is withdrawals by the owner, we would then list those and subtract them. And the final balance in C. Taylor capital, December 31st, 2019 would be $33,195. So you could think of a statement of owner's equity as kind of like a bank statement you get. Think of your checking or savings account. The bank is telling you what they owe you, right? They're saying, okay, you started with this balance. Here's the money you put in. Here's the positive things, the investment you put in. Here's some interest you earned. And here's the money you took out. So here's what you have left. And that's what a statement of owner's equity tells an owner. The final financial statement we look at is the balance sheet. Remember, the balance sheet shows the assets, liabilities, and equity on a specific date, the last day we're reporting for, in this case, December 31st. So we're just going to take the assets from the trial balance, list them with their dollar amount. Okay, if they're in the debit column, the asset, they're positive, right? Because that's the side that increases. So list each one as a positive amount and add them up and label them total assets, double underline. Go to the right side, liabilities would then be listed. There's two of them, accounts payable and unearned consulting revenue. Add those two together. They both have credit balances, so they're both positive. The last thing we list is the equity balance. How much capital does C. Taylor have at December 31st? Well, you determine that on the statement of owner's equity. So all you have to do is rewrite it. C. Taylor capital, $33,195. Add the liabilities to the equity, label them as such, double underline, and make sure assets equal liabilities and equity. So that is how we complete financial statements in the real world. In our accounting cycle in the beginning of the year, up to the point we're about to do financial statements, we record journal entries from transactions and post them immediately into the accounts in the general ledger, whether the company uses T accounts or balance accounts. Both are acceptable. When we want to do a financial statement, we will then determine a balance in each account if we're not keeping a running balance, and then create a trial balance where we list each account in the general ledger with its current balance, either a debit or a credit. We make sure our debit column and our credit column equal. Now in Chapter 2, we demonstrated and show you, hey, you could make financial statements at this point using the information from that trial balance and the 3 financial statements you're responsible for. Now some presentation issues that I don't really focus on, but your author likes to. Notice we don't use dollar signs in our journals or ledgers, but on the financial statements we do. Okay, and we usually put them beside only the first and last numbers in a column. When amounts are entered in the journal ledger or trial balance, commas are optional. So I even tell my students in my day class, sometimes I put them, sometimes I don't. I focus on the numbers, but we always use commas on our financial statements. Companies commonly round amounts and reports to the nearest dollar. Okay, some even do it to the nearest thousands or millions. So, and it depends on the size of the company. But in our little world, we're going to stay to the dollars. Notice there's no cents being used in our computations or our presentations. So this is the, you started in Chapter 1 with the analyzing, but Chapter 2 is where we really get into the technical side of accounting. Learning how to debit and credit, remembering those rules, and the steps on how we do the recording, posting, and trial balance. So please, any questions you may have, please post to the discussion board.